What keeps people wealthy is not brilliance. I know that disappoints a lot of people, especially the ones who still believe riches are mostly a reward for intelligence. I have known brilliant men who could read a balance sheet like a priest reads scripture, brilliant women who could dissect an industry in an afternoon, brilliant traders who could tell you exactly why the world was mispricing risk. I have also watched many of those same people get wiped out, sometimes once, sometimes twice, sometimes so thoroughly that the first loss never really ended before the second one arrived. So no, intelligence is not the separating line. The separating line is preparation. It is whether you saw the storm while other people were still calling it weather. It is whether you treated prosperity as a permanent condition or as a temporary mood. It is whether you built your financial life in such a way that when trouble came, you still had the one asset panic can never buy back, which is the ability to think clearly. That is why I have always loved cash more than Wall Street thinks is fashionable. Cash is not exciting. It does not impress anybody at a cocktail party. It does not create headlines. It does not make people whisper that you still have your fastball. It just sits there, modest, unromantic, silent, earning a little, waiting. But I have spent my entire adult life learning the same lesson over and over again. The game is not won by the person who looks smartest at the top. The game is won by the person who is still solvent, still liquid, and still emotionally functional when the floor begins to shake. That is what people do not understand about what I spent the better part of 2024 and 2025 doing. They looked at the cash pile and thought it meant fear. They looked at short-term treasury bills and thought it meant age had finally softened my appetite. They looked at a market sprinting upward under the weight of AI euphoria and decided the old man had become cautious or boring or worst of all, irrelevant. That was never the right reading. I was not retreating from the game. I was loading ammunition because once you have seen enough cycles, you stop asking the silly question that amateurs love asking, which is how much money can I make while everything feels easy? You start asking the serious question, how much flexibility will I still have when everything stops feeling easy? That is the only question that matters once you have watched a few tides go out. And the tide always goes out. Every single period of market euphoria eventually hands the stage to something colder, uglier, more arithmetic, less flattering to the people who confused a rising tape with their own genius. It has always been that way. It will always be that way. Markets do not repeal gravity any more than human beings repeal greed or fear. They only delay the recognition. So when I say I do not like what I see in 2026, I do not mean that I am making some theatrical prophecy or asking you to panic. I have no interest in panic. Panic is the mind surrendering before the facts require it, and panic, as I have observed for decades, is usually not a response to the storm itself. It is a response to being unprepared for the storm. When people have cushions, cash, low debt, flexible expenses, and a sensible idea of what they own. They do not panic the same way. They may feel concern, they may feel discomfort, they may make adjustments, but they do not turn into forced sellers. And forced sellers are the people who finance the fortunes of everyone else. That is where I want to begin. Not with headlines, with structure. Because the wealth gap created in recessions is not created during the recession. It is created in the months before it, when everybody still has the illusion that they have time. That is where we are now. I have seen enough of these periods to know what they look like. On the surface, life still feels normal enough. Restaurants are still full. People are still booking trips. The market still has enough strength in it to make doubters feel foolish. Some companies still trade as though the future will arrive gift-wrapped and frictionless. The commentators still use words like resilience because the machine has not yet visibly broken. But underneath, something changes. The leading indicators soften. The labor market begins to lose the little sheen it had left. Small businesses, which are far more important than fashionable people like to admit, begin speaking in a different tone. Consumers keep spending, but their confidence and their actual comfort part ways. Housing stops acting like a pillar and starts acting like a private recession hidden in public. Oil begins behaving like a tax collector rather than a commodity. That is when I start paying especially close attention. Not because I think one indicator predicts destiny. I have never trusted single variables to tell the whole story, but because fragility is always a pattern before it becomes a headline. And I see a pattern moody, S-raising recession, odds to levels serious enough to deserve respect. J.P. Morgan seeing meaningful risk. Goldman Sachs never eager to sound alarmist. Admitting the probabilities are no longer trivial. Job losses that are not large enough yet to dominate conversation, but large enough to alter the tone under the surface. Consumer sentiment eroding, small business optimism fading. A housing market that has already begun to wobble in ways ordinary households will not fully appreciate until they need it. Then oil. Oil is one of those old-fashioned forces people forget until it reaches up and puts its hand around the economy's throat. People talk about gasoline as though that is the story. Gasoline is not the story. Gasoline is the visible symptom. Oil is a tax on movement. It changes the cost of shipping, manufacturing, heating, agriculture, logistics, plastics, travel, chemicals, and mood. It leaks through the entire system. It raises costs for people who have no mechanism for pushing those costs onto anyone else. It pressures margins, it changes behavior. It arrives as inflation in places most people are not mentally prepared to call inflation, because they think inflation is only one number on a government report. When conflict in Iran pushed oil to levels that serious economists associate with prior recessions, I did not need a television host to explain why that mattered. I have lived through enough of these episodes to know what that kind of pressure does. It does not merely make things expensive. It makes the economy brittle. That brittleness is what concerns me. Not because recessions themselves are new. They are not. Recessions are ordinary guests in capitalism. They arrive, they break a lot of furniture, and eventually they leave. What matters is whether you meet them with your financial house built out of dry timber and debt, or with a stone foundation and cash in the cellar. That is why I keep coming back to the same ugly but useful idea. Lean people are free people. I do not mean physically lean. I mean financially lean. A lean household is one that has lowered the burden it carries before the world forces the issue. It knows the difference between what it owns and what it owes. It understands the difference between what it earns and what it has actually built. It does not confuse a financed lifestyle with wealth. Most people do. That is one of the great illusions of prosperity. Income rises, and instead of widening the gap between earnings and expenses, the household widens the performance. Better apartment, better car, better vacations, better dinners, better branding, more subscriptions, more recurring obligations, more things that feel harmless one by one and become suffocating when piled together. The person feels richer because the visible markers improved, but markers are not the same thing as margin. I care about margin. The gap between what you earn and what you spend is where wealth is born. Not in title, not in lifestyle, not in aesthetic. In the gap. That gap is what becomes savings. Savings become optionality. Optionality becomes calm. Calm becomes better decisions. Better decisions become purchases made when other people are frozen or being liquidated. That is the full chain. Break the gap, and you break everything that comes after it. Which brings me to debt. I want you to think about debt in the least flattering way possible, because debt becomes especially cruel in environments like this. Debt is not merely a number on an app. Debt is a claim on your future labor made by a version of yourself who believed tomorrow would be cooperative. Every dollar you owe is work already pledged. And the interest on that debt is a relentless, silent tax on a future you do not fully control, that is manageable. When times are smooth, it becomes malignant. When times are rough, a high-interest credit card balance is bad enough in a normal year. In a downturn, it becomes a pressure chamber. The hours get cut, or the bonus disappears, or the side income dries up, or the job search stretches from 1 month into 4. And meanwhile, the interest keeps charging as though none of that happened. It does not slow down because your life did. That is what makes debt so dangerous. It does not care if you carry a few $1,000s at 22% interest and only make minimum payments. The damage is obvious enough if you are willing to do the math. You end up paying back far more than what you borrowed, but even that understates the injury, because the true cost is not only the cash that leaves your account. The true cost is what that cash could have become, had it not been claimed by the past. That is the thing almost nobody sits with long enough. Every dollar sent to service stupid debt is not merely gone. It is unavailable for compounding. That makes the bill much larger than people think. I have watched compound interest build miracles and destroy futures using exactly the same arithmetic. It does not take sides. So the first order of business in a fragile economy is not to become clever. It is to become solid. I would rather see a person eliminate high-interest debt and build 6 months of liquidity than try to outperform the market from a structurally weak position. A financially weak person in a downturn is like a man trying to discuss architecture while his own roof is on fire. The conversation may be interesting. It is also irrelevant. This is why I say the market is not the first problem for most people. Their structure is, once the structure is sound, then we can talk about the market itself. And I want to say something very directly here. The market is not the economy. People repeat those words often enough, but very few understand what they mean. The economy is activity, jobs, output, production, earnings, business conditions, consumption, inventories, lending, construction. It is the actual organism. The market, especially in the short run, is mood. It is a popularity contest among participants who are often acting on incomplete information, recent price action, social reinforcement, fear, greed, momentum, professional incentive, career risk, and boredom dressed up as conviction. That distinction matters enormously now, because for much of 2024 and 2025, the market was treating a narrow group of technology companies as though they had secured permanent rights to extraordinary growth at extraordinary margins under extraordinary conditions without serious interruption. That is too much extraordinary for one sentence, and yet it was sitting inside prices as though it were normal. The Magnificent Seven came to dominate the index in a way that should make thoughtful people uncomfortable. When 7 companies come to represent such a huge share of the total market's value, and those 7 are all being bid up on some mixture of real promise and speculative fever, the whole structure becomes more sensitive than it appears. I am not arguing the technology is fake. I saw the internet. Boom, the internet was real too. What I learned then, and have never forgotten, is that a technology can be world-changing and still be disastrously overpriced. That is one of the hardest lessons for human beings to absorb. They think being right about the future is enough. It is not. You must also be right about the price. If you pay a wonderful price for a wonderful business, time becomes your ally. If you pay an absurd price for a wonderful business, time can become a very long punishment, even if your thesis is broadly right. That is what people missed in the late 1990s. The internet changed the world. It still took many investors more than a decade to recover because they paid fantasy prices for real progress. Price is what you pay. Value is what you get. People love quoting that line because it sounds wise. Very few people act as though they believe it when euphoria arrives. And euphoria did arrive. Some of these companies were trading at valuations that required the future to not merely go well, but to go well continuously. At scale, without serious competitive erosion, political interference, margin compression, or demand disappointment. In other words, they were priced as though hope were a durable asset class. Hope is useful in life. It is dangerous in valuation. Now let me tell you what that means for an ordinary investor. It does not mean hide under the bed. It does not mean sell everything and wait for some perfect catastrophe. It means understand that the best bargains are almost never available when everybody feels safe, and the safest feeling environments are often the ones in which future returns have already been borrowed from you. That is why I was happy sitting on so much cash even while people said it made no sense. Cash gives you time. Cash gives you a bid when others have none. Cash gives you the right to choose rather than the obligation to react. That is what mattered in 2008. People remember that I bought Goldman Sachs, that I bought General Electric, that I was willing to act while others were losing their heads. What they miss is that I could do those things because the preparation had already happened. The money was there, the patience was there, the thinking had been done before the panic began. That is how all great buying happens. You do not improvise courage at the bottom. You preload it at the top. That is what I want you to understand about the next 90 days. The important work is not glamorous. It will not make you feel like a genius. It is not a prediction contest, it is a sequence. First, know your number. How many months of life can you fund right now, with no new income from truly liquid savings? Not from home equity you hope to tap, not from retirement accounts you would hate to touch in a bad market, not from an uncle you might call if things became ugly. From cash and near cash alone. How many months? If the answer is under 6, that is your first mission. Not because 6 is sacred, because 6 is often the difference between being a chooser and becoming a forced seller. Time is the most valuable thing cash buys in a downturn. It buys time to find work, time to wait, time to think, time to refuse a stupid move, time to survive without liquidating your future at the worst possible moment. Second, eliminate the bleed. List every debt by interest rate. Highest first, there is always some leak in the household that everyone has emotionally normalized. The card, the loan, the finance thing that looked harmless when times felt easy. Attack the expensive leak before you talk yourself into sophistication. A person earning 10% in the market while paying 22% on revolving debt is not investing. He is volunteering for arithmetic humiliation. Third, automate restraint. The human mind is not designed to make the right financial decision every pay period in a world engineered to exhaust its judgment. So stop relying on willpower, build systems, move the savings before you can touch it, move the debt payment before you can rationalize skipping it, move the reserve build before lifestyle gets another vote. I have always preferred systems to promises. Promises are emotional, systems are structural. Fourth, prepare to buy, not recklessly, not because red screens alone are a bargain, but because one day soon enough, fear will give you the chance to buy good businesses at prices that finally acknowledge reality. When that happens, the people with cash, low debt, and emotional room will be able to act. Everyone else will be too busy surviving. That is how wealth transfers happen, the prepared buy from the frightened. And what is especially sad is that the frightened often think they are making prudent decisions in that moment. They sell because they cannot endure any more pain, because they need cash. Because nobody taught them that price and value part company most dramatically when the crowd is at peak despair. That is why I tell people to study businesses before they are cheap. If you only begin learning what you own when it is down 30%, emotion will own you before knowledge can catch up. Know what a business is, know what it earns, know what protects it, know what could hurt it, know what it would roughly be worth over 10 years under sensible conditions. Then when the price falls because the world has become noisy, you can ask the only question that matters. Has the value changed or only the mood? That question has made a lot of money for people willing to ask it when asking it felt hardest. There's something else I want to say because it matters more now than in easy times. Your attention is part of your financial structure. We live inside the most aggressive attention harvesting machine ever built. News, social media, alerts, commentators, feeds, endless streams of fear and stimulation, calibrated not to inform you but to keep you activated. The more frightened or excited you are, the more valuable your attention becomes to someone else. So ask yourself, every single time the noise spikes, who benefits from my panic right now? Not you, almost never you. That is why I have always reduced my appetite for financial noise. When conditions get unstable, information matters. Noise kills. There is a difference. During a panic, the ratio of noise to signal becomes grotesque. For every useful piece of fact, there are 100 emotionally optimized fragments designed to make you click, react, share, opine, and above all, lose your calm. Calm is expensive to reacquire once lost. Protect it. That may mean limiting your financial news diet to once a day. It may mean reading only people who focus on fundamentals rather than adrenaline. It may mean asking, after every piece of media, whether this changes your understanding of long-term value or merely agitates your nervous system. If it is just agitation, it belongs in the trash. Now let me tell you what wealth really is, because people lose sight of this exactly when they need to remember it most. Wealth is not the accumulation of things. A bigger house is not wealth if it owns your schedule. A nicer car is not wealth if it shortens your runway. A rising portfolio is not wealth if it turns you into a basket case every time it dips. Wealth is freedom. Freedom to say no, freedom to wait, freedom to think slowly, freedom to buy when others must sell. Freedom to avoid humiliating bargains with your own future. That kind of freedom is not a built-in dramatic moment. It is built in quiet, almost invisible decisions repeated over a very long time. The decision not to upgrade, the decision to save before spending, the decision to kill a debt, the decision to keep cash even while it looks boring, the decision to leave room in your life for uncertainty before uncertainty demands room. That is how real fortunes are protected. People love to analyze portfolios because portfolios are visible. They love to debate strategy because strategy sounds grand. They do not like discussing living below your means because it sounds pedestrian. But if you want to understand why some people come out of every storm stronger, you usually find the answer somewhere much duller than the headlines. A modest house, a conservative balance sheet, a refusal to overextend during the good times, a quiet respect for liquidity, an instinct for patience. Those are not television-friendly virtues. They are just winning virtues. I want to leave you with something concrete. If I were starting from scratch in this exact environment, I would do 4 things in order. First, calculate my true monthly burn with brutal honesty and identify exactly how many months of independence I already own. Second, strip away every expensive form of fragility. High-interest debt, stupid recurring expenses, vanity costs disguised as necessities. Third, automate a reserve until 6 months becomes the minimum, not the aspiration. Fourth, build and study a watch list of businesses worth owning when fear finally hands me a price. I do not get in euphoric markets. That is it. No grand theories. No theatrical macro heroics. No pretending I can forecast the precise date trouble arrives. Just preparation. Preparation works in almost every scenario. If the storm deepens, the preparation protects you. If the storm softens, the preparation still improves your life. Cash still matters. Low debt still matters. Clear thinking still matters. Good businesses bought at better prices still matter. This is why I do not see preparation as pessimism. I see it as permission. Permission to stop being the person standing outside without a coat because everyone else was telling him the clouds were nothing. Permission to become the person who is ready before being ready becomes fashionable. That person is almost never celebrated in real time. But years later, he is usually the one still standing, still liquid, still clear, and often much richer than the people who mocked his caution when the sky was still only gray. The storm may come exactly as feared or partly as feared or in some shape nobody currently predicts. That is not the central question. The central question is whether you will meet it as prey or as prepared capital. That choice is still open, but not forever. And that, more than anything else, is why I am speaking this plainly. Now,